Hey everyone, Eric here. In this video, I'm going to help you understand what is financial modeling and what is the purpose of a financial model in the real world. After that, we're going to walk step by step through how to build a simple financial model. Okay, let's get started. Okay, so let's talk about what financial modeling is and then talk about the components of a real financial model. So, a financial model shows a prediction about the future financial performance of a company. And it's very important that I say the word future because anything related to future predictions is the field of finance. Anything related to analyzing and organizing data about the past is called accounting. So accounting is more focused on accuracy in the past, and finance is more focused on not necessarily getting it perfect, but making good predictions about the future. And of course, they'll never be correct, but it's all about trying to build predictions that make sense. So the most common type of financial model is called the income statement, or also known as the profit and loss statement. And the income statement shows the sales from our business minus the costs. So at the bottom of the income statement, you have a line that shows us the net profit of the company, which is how much money we made or lost from doing business. And so what would we use a financial model for? Well, the first thing is to anticipate the future so we can have an idea of what's going to happen financially so that we have the opportunity to make changes. So for example, let's say we want to roll out a new product at a certain price point. When we build the financial model, we might see that the price point is too low and we're actually going to lose money. We might see that we need to change some of our costs. So it allows us to analyze new opportunities about the future so that we can have more confidence about going forward, or maybe we're less confident and we need to make changes, but it gives us information about things that haven't happened yet. And so that's why finance is very powerful. What else do we use financial models for? Well, one of the biggest reasons is to raise investment capital. So if you need a venture capital investment for your business because it's losing money, but in the future it's going to make money, you would need to show financial models. You would need to be able to predict the future business to get investors to invest in your company. Also, if you need to get a loan, so a debt investment, you would need really solid financial models that would show that you could pay off the loan. So they're very useful for running companies, getting investment in companies, and just sort of seeing the future before it happens. So steps to creating financial models. So now we are in the part of the video where we're going to talk about how to create a financial model and what are the basic sections of a financial model. How should we move through it? So there's a few components of a financial model. You have step one, which is building the revenue plan. The revenue is the sales. It's the same word. And so to understand what the sales are going to be, you need to understand what products you're selling, how many orders of each product you expect, what are the prices of each product, and then you need to understand new customers, returning customers, if you have any discounts or promotions, things like that, to build your actual sales. Next, you have something called the cost of sales. So the cost of sales are all of the direct costs related to delivering the product. So when I say direct costs, I mean if you're selling, for instance, a clothing item, the direct costs are the thing that touch the piece of clothing itself. So the materials, the labor for the people that are involved in the manufacturing of the clothing, maybe shipping from the clothing. So any costs that are directly touching the product are in a section called the cost of sales. Next, you have something called the operating expenses. So this is step 3 of building the model, collecting all the information and projecting your operating expenses. These are the fixed costs of the business. So things that don't necessarily touch the product, but that are important. So this would be all your corporate payroll. So these people probably don't touch the clothing in any way, but they're running the marketing. They might be the CEO, they might be the accounting team, maybe your office rent. So you have a lot of costs that don't touch the product. And then once you've collected all those costs, you can start to understand what is the profit margin, because the profit margin is the revenue minus your cost of sales minus your operating expenses, and that is what your operating profit is. But there's different types of profit margins. You have your gross profit margin, which has to do directly with the product itself. You have your operating profit margin, which is your profits but before taxes, and then you have your net profit, which is your profit after taxes. So let's jump into a real financial model and walk through how we build one. By the way, if you're finding this content valuable, please like this video and subscribe to my channel right now so that you don't miss any of my new videos. Okay, so here's the setup for a financial model that we're going to build right now. So you can see I put step 1, step 2, step 3, and step 4 next to the sections that we're going to build. And this is the format of an income statement. Generally at the top you see revenue, then you see costs of goods sold, which are your direct costs, then gross profit, which is the profit that you derive from the sales of the product, but it does not include fixed costs. Operating expenses are your fixed costs, and then you have different types of profit depending on if you include or exclude taxes. So let's walk through how you would build something like this. So step 1, revenue plan. So typically with a revenue plan, the first thing you need to figure out is how many orders you're going to sell. And so let's say we are a clothing company, like I just mentioned, and we have an online store, so we're an e-commerce business. We have no physical locations, it's all a completely digital store. And we are driving sales through online advertising, through Facebook and Google and Pinterest and Reddit and anywhere else we can do advertising. So to get the number of orders, we need to use something called the customer acquisition cost. So let's say that the customer acquisition cost is 40. So the customer acquisition cost is the amount of advertising spend we need to spend to get one new person to buy for the very first time. So for every $40 in marketing, we are able to get one person to buy. So after spending $40 in ads, one new person buys. So our customer acquisition cost is 40. Let's say in year 2, it goes down to 35. In year 3, 30. In year 4, 25. Okay, so now we have our customer acquisition cost, but now let's talk about our average order value. So that is the value in sales of one order on average. So let's say our typical customer is buying $89 in their typical order. So they're buying a couple different items, and on average, if you look at all the sales divided by all the orders, the typical order is $89. And we spend $40 of those $89 on marketing. Okay, with this information, we can predict the entirety of the revenue plan. So what we're going to do is we're going to take $100,000 in marketing, and I am just putting that budget out there to show in year 1 we spend $100,000, year 2 $250,000, year 3 $1 million, year 4 $3 million, just to show a business scaling up over time. But again, I just completely made those numbers up. So if we spend $100,000 in marketing and it costs us $40 in marketing to get one new order, then the new orders are going to be $100,000 divided by 40, $2,500. So here I can copy this formula across. I can hold down Control and tap C, hold down Shift, right arrow 3 times, and Control and tap V. That's paste. So now you can see that here we spend $3 million, and every $25 that we spend, we get one new order, and that amounts to 120 new orders. But a really important part of predicting financials is understanding, okay, someone buys for the first time, but how often do they come back and purchase a second time, or start to repurchase? So let's put a return rate in the model of 60%. And this is an annual return rate because I'm looking at this on an annual basis. It's not a monthly model, it's an annual model. So 60% means that of all the people who bought in year 1, 60% are going to come back and buy in year 2. So I'm going to take the total from year 1 and multiply it by 60. And this is going to be 1,500 orders. Control C, right arrow, Control V. Copy this over, and then you can see that you have new orders, you have returning orders, and then your total orders down below. So your total orders times your average revenue per order, which is called your average order value, is going to be your total revenue. So let's go up, and remember, step 1, you stay in step 1 until step 1 is done. So it's build the revenue. So I'm just going to link in here orders, I hit the equal sign, go down below, link in total orders. It's nice to put something like total orders at the top. Not everyone does it, but it gives you a sense of sort of, how much are you selling and what are some metrics beyond just the dollars or the currency that reflect the operations of your business. So for revenue, all we need to do is take total orders times average order value. And so in this case, Control C, right arrow, Control V, you'll see that this gives us our annual sales. So it's 220,000, then it's almost 800, then it's 3.5, and that's 12.8. And so we're an e-commerce business, and businesses that sell digitally online can scale really, really fast because there's nothing that prevents them from growing. They have no physical infrastructure to limit their growth. All they're doing is just selling and selling and selling as fast as they can. So really a lot of e-commerce businesses do grow like this. It's quite common. So now let's move on to step 2, cost of sales. So the direct costs related to our product. So if we're manufacturing clothing and then customers place an order on our website, we pack their order into a box and then we ship it, those are all of our costs of sales, direct costs that touch our product. So let's talk about the cost of goods sold, COGS, per order. So let's say that on average for one $89 order, the cost of the actual product, the cost of the clothing, is $17. So $17 here. Next, we're going to have fulfillment. So fulfillment is the cost of all the employees working in the fulfillment center, of the boxes, of any packing materials, as well as the shipping cost to ship it from the fulfillment center to get to the customer's door. So let's say that the typical $89 order costs $28 and has $28 in fulfillment costs. And then finally, the other thing that touches the product directly is customer service, because these people speak directly with the customers about the product. So we consider that a cost of sales cost, and we're saying that it's $7 on a per order basis. Let's say we have a team, maybe 1 or 2 customer service people, and their salaries divided by the total orders ends up being about $7 of customer service cost per order. So now how do we calculate the full numbers? Well, these are per order costs, so we just need to multiply these numbers by the number of orders. So let's go ahead and do that up above. So for product, I'll just do equals. I'll link in the number of orders, but in this case, I'm going to actually tap F4, F4. Okay, so you can see that I have a $sign here in front of the 37, in front of the row. So that's going to lock this row so that I can basically just write this formula one time. So now I'm going to multiply this by product costs. And I'll explain that formula to you here in a second. So if I multiply this across, you can see that your product costs are getting multiplied the number of orders times the product. But then if I take this formula and I copy it down here, and I'm just going to take away the $signs. And with financial models, by the way, generally you'll have a $sign, so this is called an accounting format here, on the top row of each block of data and on the bottom row. But in the middle, you do just commas like this, and it's just a best practice that we do in the industry, and it makes it look a little bit cleaner. Okay, so what happened when I copied this formula? Well, because I put the $sign in front of the 37, it continued to be locked to row 37, even though I copied it down one cell. But because I didn't lock this cell, the reference moved down one row. So what it basically means is that I can continue copying this formula, and these references will move up and down if I copy them up and down to different rows. But the order row is always going to stay in row 37. So here you can see that, again, I copied this down, and the row is still locked because I'm locked to row 37 with the $sign. But the customer service per order cost moved down one row. So these are called cell references, and I'll include a video. I have a video that goes over sort of locked cell references, and it just improves your efficiency and allows you to write fewer and better formulas in Excel. Okay, so now that we have this all figured out, we just need to add up the cost of goods sold. So I put a little bottom border on this, and then hit equal, sum, open parentheses, and grab the whole section. So here you can see that we have our total revenue, we have our total cost of sales. So now we're done with step 2. We built the assumptions down below, And then up above, we built the projections. So now do we go to gross profit? Well, let's finish up with step 3. So step 3 is forecast your operating expenses. So step 3, operating expenses. And so in this model, we have a few operating expenses, and the main one is going to be payroll. So I'm going to say that in the first year, there's just like 1 or 2 people working for the business, and we have payroll of $100,000, and we're just running everything on Shopify and kind of doing everything ourselves. But as we grow, we hire a few employees. So we hire another employee this year at $50,000. Then we have $250,000. And then in year 4, as we're scaling up, we hire a couple more people. We're at $350,000. And then we have other expenses. And in a real business, you would probably have in the operating expenses lots of different expenses. You'd have rent, you'd have consultants, you would have legal, you'd have a lot of categories. But I'm just trying to show you what's the basic setup so that when you see a more complex model, you will immediately understand what the sections mean and you'll understand how the model flows. So in other expenses, I'm just saying this is everything. Consultants, rent, all anything else that the business has. So let's say in year 1, it's $30,000 because, like I said, we're just 1 or 2 people working on this business. And then it's $50,000. So maybe we need some more consultants to help us with marketing, to help us with legal. And then it goes up to finally $90,000. Okay, and let's say that the corporate tax rate is 28%. In the US, it looks like it's going to be 28% in the next few years. So I'm just putting that in. So now let's go back. That's all we needed here for step 3, operating expenses and the tax rate. So let's link in our numbers. So first we have payroll. So payroll, just link it in, equals, link it in. Then we have other expenses here. And then marketing, we put up above. Marketing always goes in your operating expenses. So don't forget to include your marketing because that is obviously the largest expense, one of the largest expenses at our business. Now equals sum, open parentheses, Control C, right arrow, Control V. So now we finished step 3, operating expenses. Oh, but we have one last thing. Before we can calculate these 2 different types of profit margins here and here, we do need to calculate the taxes, but that's going to come in step 4. So now we're in step 4, and let's calculate the profit margins. So the first profit margin that we have is the gross profit, and that's revenue minus cost of goods sold. So what we do is we take the revenue and we subtract cost of goods sold, all our direct costs. Control C, shift right arrow, Control V. So you can see in this case, I put in this formula before I started the video, that our gross profit margin, which means the total gross profit dollars divided by revenue, and for profit margins, you always divide it by revenue, is 42%. So this shows us that sort of after someone buys the product from us and then we make the product and ship it to them and do the customer service, we have this number left over to basically pay our full-time staff, to pay our rent, to pay our marketing. So 42% gross profit margin. And this number can vary wildly. Sometimes it's as low as 15% and sometimes it's as high as 90%. Really, really depends on the product itself. Okay, so next, operating expenses. So you have your operating income. Your operating income is your gross profit minus your operating expenses. And I call that OPEX, but that just means operating expenses. So here you can see, and this is also called pre-tax net income because it's your total profits, but before you pay taxes. You can see that in the first 2 years, it's negative. So as our business is growing, it's actually losing money. But in the 3rd year, we basically break even. And then in the 4th year, we have a very, very large profit. So now that we see the operating income, we're going to have to do taxes. So let's look at taxes. Any year where you have a loss in terms of, you don't have any profits for the business, you don't pay taxes because you don't pay taxes unless you make money. So in these losses, you can actually carry forward to offset future profits. So if I lost $1 million last year in my business and then I made $1 million this year, I actually won't pay any taxes this year because I can use the loss to offset my gain. So you can use previous year's losses to offset future gains until your gains exceed your losses. And so let me show you quickly with a formula how you can sort of calculate that. So you create something called like a tax loss. I'm calling it an asset. And what I'm doing is I just take the loss here from this year. So if I go up, you can see that I'm just linking in the loss. And then I'm adding the loss to the loss from the second year. So now you can see that we've accumulated $267,000 of losses. And in year 3, I'm doing the same thing. 267 plus, we had a gain of 100,000. But 267,000 plus 100,000, you're still net in a loss for the business. So you don't need to pay taxes that year. And then this year, I took our cumulative losses and I added the profits, and we finally got to a positive territory. So we're not going to be paying taxes on 1.8 million of income. We're actually going to be paying taxes on 1.68 because it's all the previous losses added to this profit. So the profit's a little lower because some part of the income is still not taxable. So taxes, and again, this is just a little trick. So I'm going to say if, the if formula, if our cumulative tax loss asset is less than 0, so if we've cumulatively made no profits, comma, show 0 for taxes. If cumulatively we've started to make a profit, what we can do is we can multiply this number by 28%. And this is just a simple if formula. So you'll see here that taxes are shown as 0 in all years, but in this year we have our 1.68 million tax loss asset times 28%, and we finally pay taxes, and this allows us to calculate our net income. So it's operating income minus taxes. So in year 1, you can see that our net income is negative 62%. That's our margin. Then negative 17, then 3%, and then 11%. All right, well that's all for today. I hope you now have a really good understanding of what financial modeling is and how to build a financial model. By the way, in the description below, you can download this Excel file completely for free if you want to use it for yourself. I've also linked down below to some of my other financial modeling videos. Check those out. And if you found this content valuable, please subscribe and click the little bell icon, like this video, and leave me a comment below. And also check out my online programs if you want to do more finance training with me. That's all for today. Thanks for watching, and I'll see you in the next video.